Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right.
It's rolling.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. So, Josh, we have pretty much the most exciting episode we've done, at least in the past week. So what are we going to be talking about?
Yeah, today let's talk about debt. That's the scary four-letter word in our industry, debt. But in getting ready for this article, or this podcast, I read an article, and debt has been around for a long time.
How
long?
long?
Not something new. According to a How Stuff Works article, which we'll link in the show notes, debt can be traced all the way back to the Mesopotamia era, which is about 8,000 BC.
It's a while back.
They used clay tokens to track loaned sheep and wheat. So if you loaned out your sheep or your wheat, then you had these tokens as a form of reminding that, hey, you owe me back something for that sheep or wheat.
That totally sounds like a Settlers of Catan reference.
Yeah, it's just crazy.
Like your wheat and your sheep.
Yeah. So, Austin, when I say debt, what comes to your mind? What do you think of when the word debt is thrown out there?
Yeah, I mean, there's a lot of weird things that come to my mind a lot of the time. But when I think of debt, I think of like owing someone something. Doesn't necessarily have to be money. It can mean sheep. It can mean whatever. But it's about not having enough assets or whatever you need to fulfill your obligation that you kind of have agreed upon. And it's typically not free. And in fact, I'd probably say it's never free. You know, there's always a cost somewhat associated with debt. And those costs are above and beyond the purchase price, and it's called interest. So interest is the cost that you pay on top of what you owe for the lender, because you're really tying up their funds when they're lending them to you, and they're taking on the risk that if you don't pay them back, there could be out the money. So that is interest.
Okay. So I am interested in learning more about this. So tell me, walk me through this, kind of break down pieces of debt and interest in general.
Well, first of all, I see what you did there. That was a punny pun. But there's really a couple areas when you think about interest that I think about as it relates to debt, and those are interest rates. So that's part one, and part two is collateral. So we'll talk about rates first. Rates can really be broken down to a couple different categories. Fixed rate interest is really where the interest rate is fixed. So that percentage of extra you're paying to the lender is fixed throughout the lifetime of the loan. There's also variable rate interest, and these can fluctuate over time, generally in the direction that the overall interest rate environment is moving. And there's often a period where it's kind of locked in, usually at the beginning or whatever, when you think of something like an adjustable rate mortgage or whatever. So
mortgage is a good example of both. You could get a fixed mortgage where you say, I have a 3% mortgage for 15 years, and so every year I'm getting this 3% interest rate charged on the loan of the money.
Yeah.
As I pay it off, the loan balance goes down, but I'm still paying the same interest rate the whole time.
Correct.
And then there's a variable where it's called an adjustable rate mortgage, but it starts out maybe at a lower interest rate. Maybe it's 2.2% or something. But after 5 years, it adjusts to whatever the current interest rate is. And then for the rest of the life of that loan, then I have a higher interest rate.
Okay. And I think that a lot of like credit card rates and stuff are adjustable rates, and they can float up and down and stuff like that. But we'll talk a little bit more about credit cards later. The second part that I mentioned was collateral. So when you're looking at debt, you can have debt that is collateralized, meaning that there is a hard asset. So a hard asset is like a house or a car or like something tangible. And is a hard asset the lender can come back and take if you're unwilling or unable to make your payments. So you'll find that rates on these collateralized loans are typically lower because, like I said, there's less risk when the lender can come back and take those assets from you. Also noteworthy, depreciation treats homes and vehicles differently. So that's why you'll see difference in rates between the two. Homes typically go up in value over time. So rates can be really low because the risk is lower for the lender. But vehicles, on the other hand, depreciate the second you drive them off the lot and become less valuable over time. So interest rates need to be higher to cover the risk that the lender's taking that's increased. So little fun fact there. The
so
second,
going to that real quick, Austin, that, and I think for a lot of people to understand, that's why there's different interest rates for different things. Is why is my home rate different? Is because whoever's lending out the money wants to be sure they have a high probability of getting that back. And if they don't have a high probability, they want to be compensated for that with something that will give them something to help out offset those costs.
Right.
So if something's going to decrease in value, I'm going to want higher interest rate because there's a chance that 10 years from now, that's going to be worth less. And if I have to take it as collateral, I may not get all that I lended you out of that.
Exactly. And even when you think about, corporate or municipal bonds, these are, or, any bond really, the more risky it is, the less likely that the government or the municipality or the corporation is going to be to make those payments, the higher the interest rate is going to be to the consumer or the investor who's holding that, because the risk is higher.
Yeah.
So risk and interest rates have a direct correlation. They move in the same direction. So the other half of that is unsecured debt. Unsecured debt is where things get a little hairy. It's when you don't have that hard asset backing the debt, so the risk is higher for lenders. They can't go back on things, and it makes them charge higher interest rates for that.
Okay, I thought it was a debt that just wasn't confident in their ability. So that would be insecure debt, but unsecured debt is where it's not tied in. Okay.
Yes, debt insecurity.
Yeah. I
should add that for next time. Believe it or not, student loans are actually an unsecured debt. There's no hard asset that a lender, specifically, whether that be the federal government or private loans or whatever, can go back on and take away from you if you stop making payments. And that is a controversial topic, but that is the explanation of why student loan interest is higher than, say, a car or a house. It's a lot higher than those.
Which is also why a lot of times they want a cosigner, like your parents or somebody, because they want more people to have the obligation to pay that back if the first person isn't able to.
Some other examples of unsecured debt is like credit cards, because you can put whatever you want on a credit card, and they're not going to go through and say exactly what you bought from where you bought it and go take it from you. So that's why the interest rates are extremely high on credit cards. Personal loans are similar. So yeah, it's very, very interesting. And it's all about risk, whether it is through collateral or not having collateral. It's just about the risk that the lender is willing to take, and they're going to be compensated through higher or lower rates.
Yep. All right. So that helps explain debt in general, kind of the pieces within debt. You have an obligation or owing. Now, there's kind of two different categories of debt in my mind. There's good debt and there's bad debt. So good debt is anything that, in my opinion, is tied to an asset, like you said, that is growing in value, or it's tied to something that's going to provide greater income for you in the future.
Right.
And then opposite, that would be bad debt, which is tied to an asset that's losing value, or it's debt that hinders your ability for income.
So what are some good debts and some bad debts?
Yeah. So an example in my mind of good debt, you mentioned one already. In my mind, student loan debt is a form of good debt because a college education increases your ability. Now, if you have the right major, sometimes you can choose a major maybe that doesn't help you have more debt than what you're going to get out of it. But in general, when you leave college, you're more employable at a higher wage. Right. And so that debt provided you with a higher income stream in the future. So of debts, when you're looking across the board, that is one that would be more on the good side of things.
Probably to a point. There's probably to a point on all of these things.
Yes. Yep. And then another one, again, you mentioned like a home, normally over the long run increases in value. So a debt tied to that asset, the asset is increasing, which makes the percent of that debt owed get smaller and smaller over time. So again, to some extent, you don't want to be, which we saw in 0809, people were over leveraged in their mortgages, which caused a lot of problems. But in general, that is a type of debt that is not necessarily a bad debt.
Right. So speaking of bad debt, some examples of bad debt, things like depreciating assets like auto loans, typically frowned upon. Sometimes, things happen. We understand that. But when you're taking on debt and paying extra on top of what you're already, of the cost of the item, on something that is decreasing in value, you're just digging a hole.
So here's a real life scenario I want to get your opinion on, Austin. Real life. Happened to me. So years ago, I was looking to buy a used car. And when I went to the car lot, found one I kind of liked. They also had a brand new car. It was a different model, a little bit smaller, but they were offering 0% financing. So
0%
financing.
For how long?
And it was, I forget. But in a sense, I had the cash to pay for it.
Yeah.
Because it was in the same price range as the used car I was looking for. I was going to pay cash for that used car. So I ended up getting the newer car, and I did the 0% financing, put the money in a bank account, and just had it automatically each month pay it off.
Yeah.
Is that good debt? Is that bad debt? Is that even debt?
That's really a kind of a conundrum. I don't even really know how to explain that. I would probably have done the same thing. Now, because even say, for example, put some numbers on the table. Say it's a $20,000 car, and you have $20,000 you can go buy a car for, and you could pay cash for it tomorrow. Or you could pay $400 a month for, I don't know, 4 years or whatever it is for that car at 0% interest. Well, that money is worth more in your pocket today than to be able to do what you need to do with, to be able to fund other purchases, to be able to invest, to be able to put an emergency account together, whatever, than it would have been to drop it all at once. Now, if you have all of those other things covered, yeah, some people are in the position where it doesn't matter.
Yeah.
But people who actually need paychecks every single month to live, that could be a lever to pull if that's an available option. And I think a lot of things kind of look like that right now because we live in a land of zero interest almost on, lending is so cheap right now. You can borrow money for nothing almost. Mortgages are 2 to 4%, depending on what you're looking at, fixed rate, 15 to 30 years, whatever. That's just dirt cheap historically. And everything else is really, really low as well, especially, at the time we're recording this, the Federal Reserve has, not too long ago cut interest rates back to zero for the first time since they came out of the Great Recession. So we're going to have low interest rates for a little while because there's still a lot of uncertainty, and that's going to make borrowing costs cheap across the board, cheaper relative to what they would have been.
Yeah. And I think you're going to see a lot of people and companies taking advantage of that when comparing the options to what do I pay in the debt as opposed to my other assets and the other obligations that I have. If the debt is cheap, a lot of times that makes a better deal than maybe raising equity different ways.
Exactly.
For funding the business.
And if you look at specifically corporations, they often, are compared on their weighted average cost of capital, WACC, W-A-C-C. And that is a component that takes the cost of their debt financing. So if they were to issue debt or bonds to fund operations or projects or whatever, and then the weighting of that in proportion of their total capital requirements compared to the weighting of if they were to issue stock, the same thing. And stock typically has a higher required return for investors. So right now, when companies can issue debt really, really cheap, their total average cost of capital is coming down.
Yep.
And that's helping, the valuation on projects and expenditures look a lot more favorable than it would have been, even a year ago.
Yeah. Whenever I see that formula written down, by the way, I have to say that formula is whack.
That formula
no one laughs at it, but I say
whack.
it every time I see it written down. And
Josh,
I
will laugh at your whack joke.
I'll message you each time I see it. So tell you.
So another thing, like a good debt, speaking of good debt, I think it's probably, in some instances, if it's done properly, considered good debt to take out a loan to start a business. If you've got a solid business plan and you've got some cash on the side to kind of fund if you need those that cash right away. If you are convinced that the cash flows are going to exceed your debt payments easily, then you should be in pretty good position, and that could be a good use, like you said earlier, of taking on debt to increase your income or to be your income if you're starting a business. Also, it's like real estate investments. A lot of people take out loans to buy a house to rent out to people. As long as their rent payments, net of their expenses that they have to keep place up, put them in the positive, then that's a good use of debt. So I think that those are some other examples of good debt. But for both of those cases specifically, it is very, very wise to have a good and solid emergency fund on the side, just to be sure that if something like COVID-19 happens and you've got to stop collecting rent or you've got to stop operating your business, that you've got your cover. You've got yourself covered on your expenses.
Yeah, because we saw a lot of that in the news where landlords who own properties were getting worried that they would be unable to pay their obligations to the bank because their renters were unable to pay them.
Right.
And so, yeah, if you are looking to do a venture like that where there's a lot of risk involved, increasing that emergency fund, making sure you have a little bit more safeguard for your finances is a very prudent thing to do.
And I did see even today, so just for reference, we're recording this on May 8th, 2020. I think today I saw that 10 million Americans in the month of April elected or did not pay their mortgage payment. So there's a reality in this interesting and difficult and horrible situation we're in, economically, that's a tough thing. But these are examples, these situations. This one is, different than anyone ever, but there are situations where it's wise to just be smart and have some money set aside. And we should probably have a full episode dedicated to an emergency fund and how you can build it up and what that can be used for. But that is, that's really good. Oh, and another thing. So you want to know a debt that could be good or bad?
Yes.
Margin loans.
Margin loans. That's the not butter alternative.
Oh, so that's so gross. Do you like margarine?
Yeah, I think, Is that like vegetable spread? Yeah, it's like.
Are you serious?
It's the next best thing. It's awesome.
I don't know if you're kidding or if you're serious.
We do use it, actually, yeah. It's easier to spread.
That's so gross, dude. I'm a butter for life guy. If it says light on it or a substitute of something fattening, I don't eat it.
No, just straight
Side note. But anyway, margin loans, not margarine.
Oh, okay.
Margin loans, so literally borrowing money to invest, right? Sounds sketchy.
Risky.
And sounds risky. Yeah, you're exactly right. And you know what? For most people, I would say it probably is unwise in general. I would say that there are some people who are very, very good traders who can take that money and they put in X amount of dollars and they can invest more than that. The ratios and the percentages are totally different for everyone or whatever, but that's kind of the general philosophy. You put in $10,000, you can invest 20. And if your amount of the total value of your investments gets down to a certain threshold, they'll ask you for more money to, bring you up. It's called a margin call. So that is something that is, if done properly, a potentially good tool. But for most investors, it's not wise because there's a lot of risk associated with that. And that's also why it's probably good to work with a financial advisor, because hopefully they would try and talk you out of that unless you're like a professional trader.
Yeah. And honestly, we've had those conversations with clients where they've said, especially, and this happens a lot in really good years. So like a 2013 or 2019, where the stock market's just up, 30% or more, and things are going great. You'll have a client say, hey, I have this equity line of credit with my home. Should I take that out? And this is different than margin, but the same concept. Should I borrow that money on credit and use it to invest because everything's going so good? I could probably earn more than my payments are for that loan. Same idea of margins, but it's the concept of, hey, if I could get more money in and grow it, this is great. But
I would say
it doesn't work out.
I would say specifically in those times, specifically last year, that's a tough one, because you have FOMO when fear of missing out, when things are going up, and you're willing to get too risky, leverage yourself out, when that's actually the time you should not.
Yes.
Historically speaking.
But again, going back, that's why you need a financial advisor. There is historically just recorded evidence that people tend to chase performance, chase returns, and then react emotionally when the markets change. And so those two things really hurt performance long term. And a good financial advisor can help you alleviate a lot of that emotional decision making where you're the fear of missing out, chasing performance, saying, man, I hear my neighbor saying this and that. I need to make sure I'm trying to do all I can to catch back up. And you make those decisions that when you have time to think back on it, you're like, why was I even considering that?
Yeah. And margin was actually a pretty sizable factor in the stock market crash in 1929 that was, record. So that is another reason to just be cautious. So Josh, I want you to repeat after me. I, Josh Robb.
I, Josh Robb.
I'm not Josh Robb. You're Josh Robb.
I'm sorry.
I, Josh Robb. Promise
to
listen to Austin
to always listen to Austin.
When he says that he is not advocating for margin loans.
That he is not advocating for margin loans.
That's right. Thank you.
So don't listen to Austin. Ever.
Wait, don't listen to Austin.
Is that what I was promising? Oh.
No
Always
margin
listen to
loans.
Austin.
I'm not advocating for that,
Right.
people. Okay. So, side note, just like you and me, I mentioned this earlier, businesses and even governments constantly weighing the pros and cons of different financing options and whether they should finance expenses or investments with debt. So, like we talked about earlier, there's bonds out there. Bonds are really IOUs from corporations or governments where you're going to lend them your money and they're going to give you a fixed, percentage of interest and then your money back at the end over time. And the more risky it is, the higher the interest rate, whether that's a more risky company or a more risky or less sure, government around the world or whatever that is. So not just consumers can have debt, but businesses and governments can have debt too. And we're in the most indebted country probably in the world. So it just happens. So that's just that's a whole nother side of debt in general, but not just consumers can have debt.
Yeah.
And that is something that we should have a full episode on in the future is bonds and fixed income in general. Because the fixed income market, fun fact, it's bigger around the world than the equity market around the world.
By quite a bit.
Exactly.
Yes.
So not everyone, but a lot of people, and even myself, tend to focus on equity markets and equity market performance. And that is great. And historically over time, equities have done very, very well. But the market size is huge. So that is a plug for a future episode for fixed income and bonds.
And speaking, you're kind of mentioning the overall kind of debt that our country has and municipalities and that. But when we look at household debt here in the U.S., one of the positives, though, that has come out of what we've seen in recent years is the average household debt is lower than it's ever been. In fact, when we look at the amount they pay for their debts as a percentage of their income, so how much of my paycheck that comes in goes out to pay off those debts, it's at all-time lows, all the way going back to the 80s. We've never been this low in our percent of payments.
What about in dollars?
In dollar terms, debt's cost can be higher. Like debt is higher in dollar terms.
Yeah. I was plugging that. It's so interesting with the way you can look at it. You look at it in dollars or you look at it in percent because people make a lot more money today than they did at the other comparison periods. Their debt level can be higher in dollars and still be lower in percentage.
Yeah.
So,
or even a home.
What that's saying is that while everyone was like crazy leveraged to debt in 2008 specifically, they're making more money now, and maybe they have the same amount of debt or whatever, but they're making more money, so their debt payments as a percent of their income is a lot lower.
Yep.
So they're a lot.
Just think about what it costs to buy a home now as what a home cost 40 years ago.
Yeah.
It's a lot higher. Does that mean there's a lot more debt out there? Well, incomes have also gone up as well. So again, you're right. And so what we actually saw is the average household debt is actually below 10% of their disposable income is going towards debt now, which was all the way above 13% back in 2007, right before the last big drop. That's probably
excluding mortgages, right?
Yeah, that's disposable debt as for disposable income. Yep.
Gotcha.
Yeah. And again, it's looking at the different types of assets. All right, let's do dad joke of the week.
Oh, I've been waiting all week for this.
Okay. All right, I actually got two for you, and they're debt related. All right. So here's the first one. I almost took out a loan last night. It was a near debt experience.
Near debt.
All right, and Austrian gonna love this one. All right. So I finally paid off all of my debt. I'm debt free now. To celebrate, I went to a concert. Guess whose concert I went to?
I'm trying to come up with a witty answer. I don't know.
Post Malone. Post Malone.
Post Malone. See, okay. Speaking of Post Malone.
Speaking of him.
I'm so out of like modern music that I hardly know who he is. But I know that he's kind of into like rap R&B kind of thing, right? He has all the tattoos.
He has tattoos. I know that.
But he is actually a really good guitar player and musician and singer, like outside of that genre. And yesterday or this morning, I don't remember, I watched a YouTube video of him covering a Nirvana song with his band, and it was awesome.
Mm-hmm.
So, Post Malone.
Yeah, sometimes when you see him in just one genre, you don't realize some of the other talents.
I know, they're just, some of those people are just talented musicians, period. They just happen to be performing in a certain genre.
Yeah, craziness. Confession, I don't know a single Post Malone song, so.
I don't either. I just know that he covered a Nirvana song.
There you go. All right, back to debt. So we talked about debts and which types we think are better than others. So now let's get in. Most people will say, you know what, I have some debt. If you own a home, most people have a mortgage on that home. You may have some credit card debt, student loan debt. There's debt out there. Like we said, the average person has a percentage of their disposable income that's going towards all those different types of debt. Most people, their objective is to get that debt paid off at some point. And we always encourage people heading into retirement that, to get rid of debt is a lot less stressful in retirement, because while I have income coming in, it's easier to look at that debt and say, okay, I'm paying for those costs, my mortgage payment or whatever it is. I have the funds needed every month to pay that down. In retirement, I'm relying on all my investments and everything I'm accumulated. Having an obligation to somebody can be a lot more stressful than while you're working. So,
right.
A lot of people's goal is to be debt-free heading into retirement. All right, so we're going to look at some ways of paying off debt. So there's a couple of things that we hear a lot. One of the first questions is, should I pull my money out of my 401k or some of my investments to pay off the debt? We get that a lot. So Austin, what do you think?
I think that is that's a common question. And I think that to answer it, I would probably say it's different for every situation.
That is the correct answer.
I'm going to channel my inner Josh Robb.
Yep.
I'm going to say, let's just put this up to moderation.
Moderation.
I think because that's saying you could probably do a little, but I understand the mental aspect of, I don't want to have these debts hanging over me when I have to be very strict on my financial plan to make sure it works out for, so that I have enough money to live on the rest of my life. I understand that. But the reality is, and especially in 2020, with interest rates being very, 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 very low, and specifically talking about mortgages, you are borrowing money at 3 to 4%, maybe less, who knows, for your house. And that 3 to 4% is a lot lower than it used to be to have a mortgage. And your money in the market, now take out crazy things like we saw in the first quarter of 2020. But in a normal stock market environment, or say you're in a 60-40 portfolio with stocks and bonds, you're going to get 6, 8, 10% potential over a long term.
Yep.
And that is greater than the cost that you're holding, to pay your mortgage, to have that mortgage. So it's different for everyone. Some people just want to do it for the peace of mind, and it allows them a lot of flexibility.
Yep.
But the tension that I think that we all have to think about is, do you want the peace of mind, or do you want the mathematical, it's going to save you $1,300 a year or whatever, who knows? But there are two different ways to look at it. Do you want the peace of mind, or do you want the mathematical right answer that's proven to be correct?
And I found in working with clients, the emotional side of finance is a lot of times more important or more impactful than sheer numbers.
Yeah.
I can show them right on paper, like you said, here's how many dollars difference there is potential, but the psychological side of things overweighs a lot of the rational of numbers. And so you always have to factor that in. And that gets us to this next thing is, okay, I have debt. There's ways out there of paying it off. So there's two big ways in general. And I still believe these were developed probably out west in like Colorado, because they're both snow related. Somebody was up on skiing and thought, here's two ways to pay off debt. So there's the snowball method, and snowball method being you start with the smallest balance and work your way up. So you list all your debts that are owed, and you take the smallest balance first and go from there. Everything else you pay the minimum on, and all the extra money goes towards the smallest balance. The reason it's snowball is if you roll a snowball down a hill, it grows bigger and bigger as it goes because it's collecting snow along the way.
I see that in the movies, but I have yet to do that in real life.
It's cool when it happens.
There's
unless
no
you're at the
hills
bottom
in
of the hill,
Finley.
and then you get squished.
There's no hills in Finley.
No. So, but the idea there, though, is as each of those debts are paid off, you take then all that money was going to that debt, move it to the next one. So it does compound and grow as each debt has more money heading towards it because there's less owed to other debts and it's added to that one. In fact, in 2012, there was a study by Northwestern's Kellogg School of Management who found that consumers who tackled the smallest balance first and then worked their way up are more likelier to eliminate their overall debt than trying to go the other method, which is the avalanche method, which is where you list them from highest interest rate down to lowest interest rate. And the reason why you do that is, again, going back to just straight on paper, the sooner I can knock out those high interest rates, the less I'm paying in interest, so I have less overall costs when I'm all done.
Right.
So this study found that people actually stick to the smaller balance to larger balance method, even though they're going to pay more in the long run.
Because it feels good, right?
It does. So and if you get wins sooner.
Right.
Because you're tackling the smallest ones first so that you're sooner to see progress.
And you're encouraged to keep going, right?
What's that?
You're encouraged to keep going.
Yes.
So you cross one off the list, you're like, ooh, that feels good. I can do it again.
Yep.
Cross another one off, and yeah, it's all in your head, but it is a very powerful tool. So I guess the question, Josh, putting you on the spot right now.
Oh boy,
which one's better?
Which one is better? So if you're asking me as a financial planner, I'm actually leaning towards the snowball method, coming back to that finance being a psychological piece.
Behavioral and psychological.
Behavioral finance is huge. And so if I know there's a higher probability of a client succeeding in paying down those debts, if that's their goal, then that method, although they may end up paying a little more interest or it may take a couple more months, that alone gives them a higher chance of success. That's the one I like. Now there is moneyunder30.com has an article on that. We'll link it in the show notes. They actually show you those two options in a scenario and compare it. And it's not a big a deal. In their scenario, they show it's only like a month or two difference and a couple $100 in the long run. So again, it's not like it's huge that, oh man, look at all this extra money I'm giving up on just to have a higher chance of success. No, but it does matter. And again, coming back to it is, I like the method that gets it done.
Yeah.
Even if it takes a little more.
Now, would you probably say that you would advise different clients different ways if you knew them and how if there's someone who's extremely
and they're all about,
extremely type A.
Yeah, then they may just put it on a sheet and they're going to stick to that. If they're very goal oriented too, where if they just have an objective and they will get there, avalanche method is great because you're going to knock those out and save some money. But you got to know they're going to stick with that plan because it may take them longer to get that first win than the other way. And you don't want them to give up or get frustrated.
Right. So Josh, any other kind of big picture thoughts on debt as it relates to, someone's financial plan and their financial situation?
Yeah, I think, debt can take a lot of focus away from the long-term goals. You could be so focused on knocking out your debt now and putting all your effort towards that you could miss out on the compounding of investments for the long-term goals. And so going back to what you said about moderation is there is a balance that needs to be put in place between short-term goals and long-term goals and make sure both are being adequately adjusted for and compensated for your current situation. Because if I'm drowning in debt and I can't even get through the end of the month without running out of money, then you need to focus on that. But if you're the average person who says, I have debt, but by the end of the month, I'm fine. I'm also adding a little bit to my 401k. You need to balance those two because the time every year wasted on not investing, that money misses out on the ability to compound in the long run.
Right.
And every year you wait is a lot of lost opportunity in the long run. And so in my mind, debt, as little debt as possible is great. I'm a big proponent of, have little to no debt.
Right.
But when comparing to some of your other goals, I've seen people make the mistake of focusing too hard on that. And then 20 years down the road, when they're getting ready to retire, they're trying to play catch up and the cost of that catch up the things they have to sacrifice or the amount they have to put in to catch back up to where they would be is very detrimental to their lifestyle and their enjoyment. Because
that's just it. I feel like some people take it, maybe it's not technically too far, but it's further than I would go. And they're very extreme on it. Like they won't take a family vacation until they get their house paid off or whatever. And I'm sitting here and I'm like, yeah, I have a mortgage, but I'm not going to not enjoy taking a vacation with my family this year just so I could, pay an extra payment or whatever on my mortgage. There's a balance. And like you said, it's moderation over time, and that's going to compound in both ways.
Yeah. And it comes to the unknown is there's things that you can't get back, like you talk about with your family, your kids are only young once. We talk invested dads. It comes back to the family lifestyle as well.
Yeah.
Like my kids are only this age once, and there's only things they're going to enjoy now that if I don't take advantage of it, there could be regret down the road. Even if I have more money because I postpone those things, what good is that money if there is nothing that I can enjoy with my family with that? And so you're right. There's a balance to be had. And I encourage everybody out there, if you're struggling with that, make sure you get some help. Because that can be, talk about stressful and overwhelming. Debt is one of those things. Money can be a big impact on your emotional and your physical health and your family health if you're constantly worried about that. So make sure you're getting help from that. But if it's just a question of, how do I balance these things? Talk to some people you trust and kind of find where does my family land on what's a right amount of focusing on the near term and what's the right amount of focus on the far term. The
yeah. I think you hit the nail right on the head. The topic of debt, it's a tricky one to navigate on your own. And it's certainly a valuable topic of discussion with your financial advisor. And you should revisit it frequently to make sure that, because things change over time. So Josh and I want to let you guys know, as our listeners, we love you. We thank you for listening. We want to let you know that we are here to help. So if you don't have a financial advisor, or if you simply want to hear more about what Josh and I do and the rest of the team here at Hicks & Zerker Capital Management, please check out the Invest With Us tab on our website, and we'll link that below in the show notes. So we work with a team of credentialed, experienced colleagues that have worked alongside our clients for nearly 2 decades to help them achieve their financial goals, and we can help you too. So check it out. There's no obligation, but we're just happy that you're here. But if you are interested, check it out.
Yep. And as always, we got on the website, the 8 principles of timeless investing. If you haven't checked that out, please download it. It's free. Just kind of gives you overarching investment themes, help to keep you on track for your long-term goals. Check out the website. And then also, Austin, how can they help us with the podcast?
Yeah, we would love it if you would subscribe. If you're not already subscribed, keep listening. We're going to push out these episodes every single Thursday. If you really like what you hear, we'd love it if you'd leave us a review on Apple Podcasts. If you have any topics or questions that you'd like us to address and talk about in an episode, email us at hello@theinvesteddads.com. And click that share button if you like this episode. Share with someone who you may feel would really benefit from learning a little bit about debt, and hopefully we can help someone out. We're really focusing on helping you out.
All right. Well, thank you guys, and we look forward to talking to you next week.
Thanks. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.